China's PMI contracted in April, putting pressure on Asian markets today. French bond yields are climbing on concerns that socialist candidate Francois Hollande could possibly become the new French president. I'm Lindsey Bell, and the morning call starts right now.
Good morning. I'm Scott Redler, Chief Strategic Officer at T3Live.com.
And I'm Lindsey Bell with theStreet, and together we bring you the morning call. This morning, stock futures are trading down on weak economic news out of Europe and China. Also, there's that political change of leadership that could potentially be happening in France. Scott, what do you think is the biggest mover of this market today?
I think everyone's trying to figure out the biggest culprit on why we're down 12 to 15 handles, but I just think it's just adding up. You're talking weeks of some negative headlines out of Europe. You're talking about some, weeks of people thinking that growth is slowing in Europe, in China. And then over the weekend, you had some catalyst with obviously the French elections. And you also had some poor U.S. data that's been coming out in the last few weeks, which a lot of bulls have been hanging their hat on. A lot of the jobs info start to take a turn for the worse versus keeping the trend to the upside. So you put that all together, combined with what I look at, the technical action, and the writing's been on the wall for weeks already.
Right. Why don't we take a look at the technicals then? Let's take a look at the chart of the SPX.
And we will take a look at it because that's what we do. We measure the technical action. We don't look at all the talk out there. We like to uncover the nuts and bolts of what's going on here. And if you look at the chart of the SPX, the writing's been on the wall, and everyone had enough time to maneuver. We talk about trends here. Here's that macro trend that started back in October. You draw the lines, and this is where the market paused after the move off the highs. You had two chances to get to cash, two chances or more actually to maybe even get short. Here is that accelerated or intermediate momentum trend that broke. This broke on the day or right around the day that IBD put us in market correction. So right around 1404, this was your way out of your longs. This was your way out if you were following this trend since market was in full-fledged rally modes from December 22nd. And if you rode it the entire time, this was your way out. Okay, your way out to switch to net short if you were trading, your way out just to get a little bit more comfy. And then what happened? We had to move off the highs to about the reactionary low of 1357. Then we retested that broken trend line because that's what markets do. They like to retest to get confirmation. And now we're opening below this ascending channel, which I spoke about in length in the last few days. And what I'm going to be looking at now is to see, do we close below this 1365, 1370 area? Do we potentially test 1357 today, which could happen because a pro gap like we have below a pattern could indicate some speed. So I would be careful. I wouldn't be just dumping or diving into your shorts. Hopefully you're already in like a tier 1 or tier 2 because of the setup, and then see how we handle this and take trades along the way all day long.
What's been interesting about this correction is that we've seen a lot of the leaders actually driving the pullback. Why don't we take a look at the Qs, because that's the tech sector, and they had been leading going up into the current part of the year.
Yeah, and you've been seeing some of the faulty leadership, and the Qs has been something to look at, and it started to dance around its 50-day late last week with no real bounce off of it. It actually tried to break above this small descending channel, but it was sold. Another distribution sign. So if you look here at the chart of the Qs, you will see that, I remember talking about this day. This was the day it tried to break out and didn't. Another sell signal. You could also draw from here that ascending little channel, okay, going into this area or this triangle that broke to the downside. And now here's a 50-day. Remember we drew this line saying, maybe the market gets back going again. We weren't sure. But then you had this day right here where it pushed through and failed. Absolutely no momentum. Plus the leaders are also weak there. So that showed you that there was no momentum for the upside. So now here we are hovering on the 50-day, opening below. If we can't reclaim that 50-day, which I don't think it's going to do today, you could see a quick move down to this area we isolated, I think, last week, right around 64. And then you also have another bigger support coming in here. And you do have the 200-day, which is a lot lower. So if we start getting to the 200-day, you're going to see a very deep correction here. I'm not sold that we get down that far, but we'll see how we handle this area right around there.
In the sector spotlight, why don't we talk about some of the specific leaders that have been winners so far this year but have been started to pull back? Why don't we start with Apple, since we were talking about the
Yeah,
tech.
Apple's something you have to watch. It was an animal last week. It pushed the envelope both ways. We talk about being in the right trade. As long as you're in the right trade, you never really have to know where it's going to go. But when it showed its technical weakness about 2 weeks ago when it broke 620, that was a trade to get short or get out. And if you look here at the chart of Apple, it's been very tradable, very symmetric. You look at the trend line here. We drew this for you. Once it started to weaken right around here, I showed you the divergence when the S&P bounced back to work off the oversold nature. This is when Apple got weaker. Here was your get out of Dodge. Here was your short entry around 620. Gave you a nice move down to that low of about 578. Then we had that red dog reversal bounce. Gave you a nice 40-point bounce into this trend line. What happened? It was rejected. Then we came lower in the end of the week. And now we're right around this 50-day moving average. So sometimes you see a little bit of a complicated trade around here because you could see some support there. But if it doesn't hold the 50-day, the market likes to flush everyone out. And if they want to flush everyone out, I will be a buyer into this 552 to 556 area. And then we need to see if we could reclaim the 50-day. Earnings are Tuesday after the close, so we'll see where we are as we get closer to earnings. But for today, I would not be shorting Apple. Even if it goes lower, it's just a dangerous short down here. And if you're going to be buying it, it's not going to be easy. Just do a level versus a level and tune into my radio because that's going to be my focus this morning.
And how about Google? That stock's below $600 now. It's had a big trade down since reporting earnings last week. What are you doing with the stock?
I haven't been doing much, and Google's been a big disappointment. I went into the beginning of the year saying it's my stock of the year. They missed last quarter. This quarter, the market didn't treat it well at all, so I'm reverting back to the technicals versus the fundamentals, which is the reason why I thought it can get going and make new highs. I'm not saying it can't, but you have to be a bit more careful. There's no reason to be all in. And last week, we started talking about this broken trend line. And when I see broken trend lines, I get a little careful. So if you look here at Google, you will see, first take a macro look here. Here is the trend line that's been intact since early October. So here's a low, another low, and this is what it broke it. Okay, guys? Here is the earnings day when, you actually could have sold it about 550, or if you didn't, if you saw it close on the dead lows after earnings, right there, that's a sign to be careful, at least for me. And then when we broke below this trend line, another sign to at least loosen up. Don't be in anything more than a tier 1, and a tier 1 only if you have a long-term plan. And then we came lower. Okay, and then if you remember, I started drawing this 600 level. It was one of the things I said you guys have to watch. If we see Google start to break below 600 with some other stocks, gives you more clues of weakness. So here's that little box. We couldn't even get up and retest this sellable area. And now we're opening near the 200-day. So I would watch the 200-day the last time on earnings, right? You had your earnings shortfall, came down, it floated all the way down to the 200-day and held. So let's see if it's a similar pattern. So if you're looking to add to your positions and you think the trend stays the same way as last quarter, this area is your first area to nibble, but don't just go in with both hands because it held here. The trade sometimes changes, so we'll know how weak Google really is if it does not hold that 200-day.
Let's talk about the financials because that was another sector that a lot of them reported pretty good results, but they traded down. They sold on the news. How about JP Morgan? That was one that definitely had good numbers. They continue to take share. They have this fortress balance sheet, and they should improve as the economy improves. So what do you see this stock doing? It looks like a good buying opportunity here, but do you think it goes further down?
At this point, it just broke another level. So when you're in a correction, you don't really care that much about the fundamentals. You want to trade levels versus levels. And this stock actually gave me a lot of clues to be cautious because, A, first when it broke its 10-day, that gave me signs that we're going to be in a market correction and to get out of some banks. And then B, decent numbers. They opened it up and sold it hard that day. That was a sign. And now we're looking at this 43 area. It's breaking below. So at this point, if you're out of JP Morgan, you saw the signs and you have opportunity to buy back. The question is where. So if you go to the chart of JP Morgan, I'll show you potentially where. Here is, that area that we bounced off. Remember when we broke below the 10-day? I actually bought this for a bounce. The bounce was, decent sized bounce for a trade. And then this was the day it was sold on earnings. And then since then, it was never able to take back more than 50% of that day, showing you weakness, showing you it can continue. And then we closed in the lows Friday, giving you some clues to be out of some stocks because, why is JP Morgan closing on the lows? Maybe they know something, but PS, now we're down 13 handles. We're coming right into this moving average, right halfway into this breakout. I would look to see, if you're not there, test it for a trade right around this 42.22. But if that doesn't hold, you have another area coming all the way down to where it broke out from, which is a little bit closer to 40. So here is support 1, support 2, and then you need to see if it tries to reclaim this broken 42.70 area. But I do think that it comes very compelling into a little bit closer to 40 is where I would think that you could be buying it back if it doesn't bounce today.
What about Goldman Sachs? We talked about that last week, the 114.50 level.
Goldman Sachs, I shorted that Thursday when it broke that level, covered a little early, but that was also another barometer, another, dot to connect that why you should not be so bullish and why you should be out of some stocks. And if you look here at Goldman Sachs, there you go. This is the line we drew right here around 114, broke on Thursday, was weaker Friday, and now see how it handles this moving average of 109.70 if you want to do for a trade. But as an investment, I think you back off. I'd rather see you buy maybe JP Morgan in the hole, a little less risk than Goldman Sachs.
How about Las Vegas Sands? That stock had been really strong so far this year. Last week it started to show some weakness, and maybe that was because of Yum Brands coming out saying there's some weakness in China. I'm not so sure, but they report earnings this week. What are the charts telling you?
Well, this has been a strong stock, and if you want to hold it long term, people are still there. But obviously, in a market correction, as the market correction deepens, they get to everything. So you need to really know your time frame. And some people sold into the strength, some people got short. For me, I'm avoiding it for now because I could always get back in. And if you're not committed, LVS is coming to a pretty big level right here. So you want to take a look at it. If you look just technically, this was a bit of a shooting star right here. A sell signal. This is when it opened at new highs and they sold it down. Wasn't so drastic, so a lot of guys, didn't really see it. But then the second day got you out of it, and now it's, it has a bit of a trend line that it's going to be opening below. I would watch right here into this 66.30. This I think could be more buyable than sellable because we just came from 62 down to here. I'm sorry, this is 56. So I think if you're still in it, you've probably been in it for a long time. There are a lot of ways to enter and exit stocks. Here is entry number 1, and if you remember, this was entry number 2 for your macro trade. So if this doesn't hold, you could see it move down to 50 and a quarter or so with the rest of the market, but I do think there'll be good things for LVS in the future, but you have to know your risk tolerance, and right now for a trade, I would watch this area really close as 57.50 and then the 50-day. So if Apple can get down to its 50-day, why can't Las Vegas Sands, or why can't anything? So just know that in the back of your head, so know if you can handle the risk.
Finally, Intel, that stock's down 3% since reporting earnings that the street didn't really think were that great. But they're investing in R&D, and they have opportunity to make something of that. But again, maybe the technicals are telling us a different story. Well,
Intel has been a darling of the mega caps, and it was at highs going into earnings, so they better, even if the margins were 64 versus 62, I think they would have sold it same way they sold VMW on a great report. That's a sign that you're in market correction mode when they just sell anything. So if you look here, you had a gap down from earnings that it never reclaimed, so that was a bit bearish. I remember that day as a trade, some guys traded it off support that day, and it was decent for cash flow. We talked about the 50-day. Usually you get down to the 50-day the first time it holds, but the more you knock on that door, the more chances you break through it. And if you look here from that earnings gap, same way you have a high side earnings gap, you have a low side, it never filled the gap, showing that this downside move here had some power and is controlling. So now we break below 27.40. I do think that you're going to be able to buy Intel a little bit closer to the support here coming in around 26.50. So even this could correct a bit more, and this would be another sign that we close below this and it can't reclaim it, that there's more downside action to come.
Well, when we come back from this break, the short break, we're going to get into the earnings the stocks that are moving up, actually. So we'll get into some strength after this.
Hi, I'm Sean Hendelman, CEO of T3 Live, where we train, coach, and mentor traders in order to help you put your money to work with confidence. The T3 Live approach is a blueprint for you to recognize, adapt, and ultimately take advantage of different market conditions. To begin your training with T3 Live, we would like to offer you the opportunity to enroll in our free 30-day online home study course. Fill in your name and email address, and I'll see you on the other side.
One more.
Welcome back. We're going to get right into the trenches with some defensive names. Let's talk about healthcare. Aetna and United Healthcare have both been pretty strong last week. When the market was down, these guys were up.
So usually for a trade, it's okay. I wouldn't say just start positioning these. It's not for me, maybe for mutual funds, not traders. But there's been some action there. So we go real quickly to Aetna. You take a look here. This was the day it woke up, if you remember. Excuse my voice. It had a big move. Retraced all the way down, came back up as the market started to get a little weaker. So I think if you want to be in this thing, just make sure it holds 48. It's definitely for the more longer term investor. We'll take another look at the stock in that area, Humana. Also going sideways, some opportunity. It's above the 50-day. But if the market itself turns back, usually they sell these. I'd rather, if you want to have a long-term portfolio and you're a little bit more risk averse, be in these names. But if you're a trader and you're looking for things that move, I would just avoid these. I would rather see it in cash and wait for the best stocks in America to come on sale and buy those at the right time.
How about retailers? It's really been a story between the high end and the low end, both doing well, in the middle kind of having a little bit of trouble. Nike over the weekend was in Barron's. They were out bullish on it, saying that stock can get to 130. Same thing with Under Armour. That stock's actually had a really good run so far this year, so it'll be interesting to see where that goes.
You still have some pockets of strength, and there are a small category of stocks that could buck a trend when the trend is down, and that's what we've been in for the last 3 to 4 weeks. Nike, I like the setup here. If you take a look at the chart of Nike, you will see that it's not extended. There's a viable setup. So if you go to the chart, it tried to poke its head above this downtrend here. It's still above the 50-day. I would say, above this area, which is about 111.44. It's a candidate to make new highs, but just again, be careful. Maybe in this down open, look to see if there's any strength there. Under Armour, very impressive. Look at the move it had on earnings. It broke that same type of pattern to the upside, closed closer to the highs. So, I think you stay with this one. If you're not committed, just make sure it doesn't give back at least, a third to a half of, Friday's gains, because that would show you that the breakout failed.
And then how about the consumer goods names? Philip Morris reported earnings last week that were really good on top and bottom lines. This is a cigarette company. Them with Lorillard, people have been piling into over the past few years because of their big dividends and good cash flows. But what are the technicals telling you?
In this group, when people want to, instead of being in cash, they want to go with dividends. They want to go with things that people might have in a recession or in a slowdown. If you look at LO real quickly, you will see that it is trending well. Technically, you take the symbols out of the way, and I would say, wow, this thing looks pretty good. I guess above 138, it can continue. It's well above the 50. It's above all these trend lines. There is definitely some demand there as far as Altria Group. Near highs. I wouldn't start chasing these things as far as, again, the market just had a big correction. This is, just look how sloppy this action here is. Like, it's fine. If you want to hold it, it's good. I'm not going to be trading it. But if you have to have stocks in a portfolio and you have some longs and you have some shorts, right now these are working better, obviously, than the financials, the tech, and some of the former leaders from the first quarter.
Some of the food companies too, and just consumer goods products like Kimberly-Clark and then Pepsi and Coca-Cola, they're talking about lower raw material costs coming in the second half of the year, so that might also benefit these names then.
Yeah, and if you look at the chart of Pepsi, it definitely is not correcting. If you look here, there might even actually be a trade here. You have a defined resistance area, which I always like to watch. You have an upper level flag right here. It's above the moving averages. So I guess if this were to start getting above the highs of 66.74 to 67, Pepsi seems poised for a breakout. But again, in a corrective type tape, I hate playing breakouts, especially in defensive stocks, because when the market reverses, these typically reverse, but it's a little different because they have the dividend. They're a little bit more conservative. So Pepsi actually has a really good looking chart pattern. Watch that level. If you look at Coke, I haven't traded this in a while either. It's actually holding up really well too. That's why I love having you here, because you show me stocks that I don't really trade that often. And this too came back to highs. This was the old high. Couldn't get through right away, corrected right back up there, flagging nicely. If Coca-Cola were to start getting above 74.50, there might even be a tradable breakout for guys looking for action. As far as an investment, still paying off, still caffeinated there.
How about the defensive stocks? I mean, it's interesting that they've been so strong going into 2013 when we're supposed to be getting these budget cuts. Honeywell was out last week increasing guidance for 2012 on strong demand in the U.S. What are you seeing in that, and maybe a Lockheed Martin?
Well, if you look at Honeywell first, I'm looking at the base up here. Again, that's just why we don't trade them, because it's really, really sloppy. It's still holding this 56 level. It opened up on Friday, traded lower. You have this defined channel. I think this is really more for like funds and not for retail investors. But it is holding. If you want to be long versus 56, I think it's okay. Above 62, it can get going. If you want to take one more look at something in that sector, LMT actually acts a little bit better, looks a bit stronger, and if you are a trader looking for some type of breakout, the breakout comes above 91, 92. It's above the moving averages. So again, take the name out of the equation and the thoughts behind it, because it's supposed to be cutting budgets. It's still acting well, but I guess one day wonders could happen where people pay attention that, oh my goodness, they're not getting their budget in and da-da-da-da. But until that happens, you can't trade with that in the back of your head. Technically, both those look decent. I think LMT is better than Honeywell.
How about we move into the quick hits? Let's start with McDonald's. They reported earnings on Fridays. That was decent, and the stock traded down.
Well, if they're decent earnings, stock trades down, stock's off the high, that technically is showing me to avoid it for now.
How about Starbucks and then Dunkin'? Those two are coming out with earnings this week. Starbucks, we know, has had a great run so far this year.
As we know, great runs in a corrective tape could be prone to some pressure. And I was looking at this chart the other day, and if you look here, obviously it was a great long from when Jill was on here and we talked about the breakout at 50. Since then, it's had a really, really nice move, okay? And here you go. This is a big-time reversal. Gave you a 2-bar move. Wasn't able to reclaim 50% of it. So to me, if you're not committed in Starbucks, I do think it breaks below this low here and can't get back above 59. You're going to see some more corrective action, probably to at least the 56 area and maybe even the 50-day or what movie? Yeah, this is the 50-day. Wow, so this is extended. I would say be careful here. Below this area, you're going to get some more downside. And traders actually might look to short this one, believe it or not, for that move for cash flow with Starbucks. And with Dunkin', I actually got stopped out because I just didn't want to be really long anything, but it still holds in there really well. I would say as a macro investor, stay with it. Put your stop here at $29.50. At some point, if it continues to go, I will be a buyer of this thing above 32 for what could be a move to about 36 to 38 this year, because still new issue, big future. Sometimes you uncover big winners in down tapes, and this is something that's holding up very well right here with Dunkin'.
How about General Electric?
General Electric, every now and then, there's like 3 times a year when I trade this stock when there's a good pattern. If you look at it, if you need to have a portfolio of stocks, this is something that people like to look at. For me, I think it looks really noisy right now. It's holding 1850, which is good. Here is your upper level flag that it broke below. So I would say if it can't get above this area where it just retested this broken trend, you could see 1850. I'd rather see you buy this thing a little bit more below 19 versus around here. So I would watch that one. If you're in it already, stay with it. That means you're a macro holder. As a trade, I don't see a real trade exciting right here.
How about last stock, IBM? It's been kind of weak since earnings.
Yeah, well, it came out with earnings, and this was another sign that we were going to get more weakness. We talked about 201, 202 in IBM, said they want to save IBM and show constructive nature for the market, it wouldn't break. And what did it do? It broke, it closed on the lows the day of the earnings, saying get out of the way for now. So we talked about it breaking that 201, 202 and said next level will be 196. And that's what happened here, right? Here's IBM. If you remember, I was long this thing, early on this year when it had that really nice, shows you entries and exits are key. This was that nice tradable pattern to the long side. It was long here, was long here. I think I sold it into this move, and everyone was kind of yelling at me, oh, you sold your IBM too early, 204, 205, and it did go higher. But now look where it is. So taking trades is fine. P.S. Here's that 201, 202, broke below it. That told me that, more weakness to come. I would say, you could be a buyer around this 195 if you want to get involved in IBM. If you sold it going into earnings because you were risk averse, then you have the luxury of buying back around this 195, 196. If this weren't, if that doesn't hold and the correction gets really deep, you could see 191, and then obviously the 200 days all the way down here. But if we get to the 200-day in IBM, that means we're probably at about 1275 in the S&P.
So we're getting into more earnings this week, and for the most part, I think most people expect them to be pretty good. But as we saw last week, good reports are getting sold off. So how are you going into this week?
So you want to watch to see if that continues. But there is a point when the market gets discounted enough that a good report can go up and hold up. And when that changes, you'll know that the market now feels as if it priced in the correction or priced in all the news. So that's what you have to look at. We've talked McClellan oscillator about being oversold, overbought. Remember when we were, at minus 92, we had the bounce. Just so you know, going into Friday, I believe we were only about like minus 20. So there is downside room here, so don't just start jumping in. As far as the earnings, again, watch where the stock came from, where it closed a day of numbers, so you know whether the street's pricing in, a so-so report, a great report, a huge report. Like Apple, for instance. Apple just came down from 644 down to, 570. So even if it's not a blockbuster Apple report the way we're used to, if it's been discounted enough, maybe it can go up, get a relief rally, and then that'll ease some pressure. So you have to know where the stock was, where it came into, what the expectations are, and more importantly, know your risk. Know if you're going to be in there for earnings, and know if you don't have the risk tolerance where you want to get out of it, trade it after hours or be in some kind of option. So at least your risk is premium paid. And then again, if you are longer term, just have high-level stops and also, put a collar on. Sell some calls, buy some puts. That's a good way to protect longer-term positions.
So manage your position.
Yes, manage your positions, manage your risk, and just expect the unexpected. We're in a very volatile tape right now, and bad times lead into better times as long as you approach it like a pro. Have a great day.